Okay, so real talk for a second. You opened your brokerage app this morning. Maybe it was Fidelity, maybe Schwab, maybe Robinhood, I don't judge, and you saw green. Your portfolio's up, your index funds are climbing. That one stock you bought last year because your coworker wouldn't shut up about it, actually doing pretty well. And for a split second, you felt good, like maybe you're finally figuring this whole investing thing out. But then you closed the app, put your phone down, and this weird feeling crept in. This nagging little voice saying, this is too easy, something's off. And maybe you Googled, is the stock market going to crash at like 11:30 at night when you couldn't sleep and you found 1,000 different opinions saying 1,000 different things, and you ended up more confused than when you started. Sound familiar? Yeah, that's because you're picking up on something real, something your gut is detecting that the headlines aren't telling you. And today I'm going to show you exactly what it is, using 3 specific, obscure, data-driven signals that almost no one in financial media is covering. These are the same types of metrics that quietly screamed danger before the 2008 crash while Jim Cramer was on television telling people to buy Bear Stearns. And right now in Q1 of 2026, all 3 of them are lighting up like a Christmas tree. I'm going to show you each one. I'm going to show you the math. And most importantly, I'm going to show you exactly what to do about it so you're not one of the millions of people who gets blindsided. Let's get into it. My name is Billy, and I spend way too much time thinking about the hidden fault lines in the global economy that nobody wants to talk about. If you're someone who's been trying to invest consistently, trying to build wealth the right way, but you've got this gnawing anxiety that you might be walking straight into a financial disaster without knowing it, make sure to hit the subscribe button and give this video a thumbs up if this helps you out. Seriously, I don't run ads for sketchy trading platforms. I don't sell courses for $997. The subscribe button is literally how this channel survives, and it costs you $0. All right, now before I show you these 3 signals, I need to destroy a belief that is going to cost a lot of people a lot of money this year. Here's the belief. If a crash were really coming, we'd see it in the data. Unemployment would be rising, GDP would be falling. The experts would be warning us. That sounds completely logical, and it is completely dangerously wrong. Here's what most people don't realize about how crashes actually work. They don't announce themselves with obvious data. They hide behind good data. That's what makes them crashes. If everyone could see it coming, people would sell gradually, prices would decline slowly, and it would just be a correction. The reason crashes are violent and devastating is specifically because they emerge from environments where everything looks fine on the surface. Let me give you a concrete example. In September 2007, this is literally 5 months before the worst financial crisis since the Great Depression, the Bureau of Labor Statistics reported that the U.S. economy had added 110,000 jobs that month. GDP was positive. Consumer spending was holding up. The Dow Jones was within spitting distance of an all-time high. If you were looking at the normal dashboard, the indicators they talk about on the nightly news, you would have seen nothing wrong. 0. You would have felt great. Meanwhile, 3 obscure metrics buried deep in global trade data, commodity markets, and bond market microstructure were absolutely screaming. And the institutional investors, the BlackRocks, the Bridgewaters, the Goldman Sachs trading desks, they were watching those metrics while publicly telling everyone else to stay calm. That's not conspiracy theory. That's just how information asymmetry works on Wall Street. They have better data. They have better tools. And they have 0 obligation to share what they're seeing with you, until now. Because I'm going to walk you through the exact same 3 categories of signals updated with real Q1 2026 data and let you decide for yourself. Signal number 1, and I want to start here because this is probably the single most honest economic indicator in the entire world. And I guarantee you 95% of investors have never even heard of it. It's called the Baltic Dry Index. Now stay with me because the name sounds boring and technical, but the concept is beautifully simple. The Baltic Dry Index, the BDI, tracks how much it costs to ship bulk raw materials across the ocean. Iron ore from Brazil to China, wheat from the United States to Europe, coal from Australia to India. It's essentially measuring how busy the global shipping network is. And here's the thing that makes it so powerful. You cannot fake it. You cannot manipulate it. You cannot spin it with creative accounting. Think about it like this. Imagine you wanted to know how healthy a restaurant was. You could look at their Instagram, nice food photos, 5-star reviews, packed dining room on a Friday. Looks great, right? But what if you could instead look at their actual supply orders? How much food are they ordering from their distributors each week? If those orders are dropping, if they're ordering 40% less chicken, 35% less produce, it doesn't matter how pretty their Instagram looks, that restaurant is dying. They know it. They're just hoping you don't figure it out before they close. The Baltic Dry Index is like getting access to the global economy's supply orders, and right now, the orders are falling. Fast. Let me give you the numbers because the numbers are what matter. In Q1 2026, the Baltic Dry Index has averaged approximately 920 to 1,050 points. To put that in context, the historical average over the last 20 years is around 1,800 to 2,200. So we're running at roughly half of normal. But the trend is what's really alarming. The BDI has fallen over 50% from its mid-2025 highs when it was trading above 2,100. Now, I want to show you why this specific pattern should concern you. Pull up a chart of the BDI from 2006 to 2009 if you want to verify this yourself. In early 2008, the BDI was still elevated. It actually hit its all-time high of 11,793 in May of 2008. But by December, 663, a 94% collapse. The shipping industry saw the economic slowdown months before it showed up in GDP, months before it showed up in employment data, months before the stock market finally cracked. The BDI peaked and began rolling over about 6 to 9 months before the equity market peaked. It was a leading indicator. It was telling you the truth while everything else was telling you a fairy tale. Now, you might be thinking, Billy, okay, but shipping rates go up and down all the time. How do I know this isn't just normal fluctuation? Great question. Here's how you tell the difference. Normal fluctuation in shipping rates happens alongside stable or growing container volumes and steady port throughput. What we're seeing in Q1 2026 is different. Container volumes at major ports, Shanghai, Los Angeles/Long Beach, Rotterdam, are down between 8% and 14% year over year in early 2026 reporting. Vessel charter rates for Capesize bulk carriers have dropped below $12,000 per day, down from over $28,000 in mid-2025. That's not fluctuation, that's contraction. That's the global economy placing fewer orders. And here's one more thing that makes this particularly ominous. Global trade as a percentage of GDP has been declining since late 2025, falling to approximately 57%, a level we haven't seen since early 2020 during the initial COVID shock. When global trade contracts at this rate during a period of supposed economic expansion, it has historically preceded a recession within 6 to 14 months, every single time. Okay, signal number 2. This is where it gets really interesting because this signal isn't about any single commodity. It's about the relationship between commodities. It's about what money is flowing into and what money is flowing out of. And it tells you more about where we are in the economic cycle than virtually any other metric. I call it the commodity rotation signal. And once I explain it to you, you will never look at the economy the same way again. Here's the concept. Different types of commodities perform well at different stages of the economic cycle. This isn't theory. This is backed by decades of data. Early in an economic expansion, industrial metals surge. Copper, aluminum, zinc. These are the materials you need to build infrastructure, manufacture goods, expand production. When these are ripping higher, it means the economy is genuinely growing. In the middle of the cycle, energy commodities take the lead. Oil, natural gas. Because economic activity is humming, transportation is booming, factories are running at full capacity, and energy demand goes through the roof. But at the end of the cycle, the late stage, right before things turn ugly, a very specific rotation happens. Money rotates out of industrial metals and energy, and it pours into what I call bunker commodities, gold, silver, and to some extent, agricultural staples like wheat and soybeans, because even in a crisis, people have to eat. This rotation is smart money's fingerprint. You can't see what hedge funds are doing in their internal meetings, but you can see the footprint they leave in commodity markets. And right now, that footprint is unmistakable. Let me walk you through the Q1 2026 data. Copper, which Wall Street literally calls Dr. Copper because it's considered so reliable at diagnosing economic health, peaked at around $5.25 per pound in mid-2025. By March 2026, it had declined to approximately $4.10 to $4.20 per pound. That's a 20% drop. Iron ore has followed a similar trajectory, falling from above $135 per metric ton to roughly $97 in early 2026. banks. Now look at what's going up. Gold hit $3,380 per ounce in Q1 2026. Silver has pushed past $38. These aren't small moves. Gold is up over 25% from where it was trading just 18 months ago, but here's the number that really tells the story. The copper to gold ratio. This ratio, literally the price of copper divided by the price of gold, is one of the most tightly correlated leading indicators for the 10-year Treasury yield and overall economic trajectory. When this ratio falls sharply, it means the market is rotating from growth assets to safety assets at the commodity level. In Q1 2026, the copper to gold ratio has plunged to approximately 0.00123. For reference, it was at 0.00180 in mid-2025. That decline mirrors almost exactly the pattern we saw in late 2007 before the ratio completely collapsed through 2008. And the central banks, oh man, the central banks, this is the part that should really make you sit up. Global central bank gold purchases hit 1,180 metric tons in 2025, and the pace through January and February 2026 is on track to exceed that. China alone reportedly added over 230 metric tons to its reserves last year. Poland, India, Turkey, Singapore, they're all buying at a rate we haven't seen in modern history. Now, you might be thinking, well, central banks buy gold for lots of reasons: currency diversification, geopolitical hedging, whatever. Sure, you're right. But let me ask you something. If you're a central banker and you genuinely believe the global economy is healthy and equities are going to keep climbing, do you accelerate gold purchases to their highest level in over 50 years? Or do you deploy that capital into something with higher returns? They're buying gold because they're afraid. They just can't say it publicly because saying it would cause the exact panic they're trying to avoid. It's the financial equivalent of a lifeguard quietly putting on their own life jacket. They're not blowing the whistle yet, but they're strapping in. Let me put real dollars on this so it hits home. If you had $100,000 in a standard 80-20 stock bond portfolio in October 2007, by March 2009, that portfolio was worth approximately $58,000. You lost $42,000. But if you had recognized the commodity rotation signal and shifted just $15,000, 15% of your portfolio, from equities into gold and short-term treasuries in late 2007, historical modeling shows you'd have preserved an additional $11,000 to $14,000 through the drawdown. That's the difference between a devastating loss and a painful but survivable one. Because gold surged 25% during 2008 while the S&P was falling 37%, 15%, that's all. Not some radical overhaul of your financial life. Just 15% moved to the right place at the right time because you were paying attention to a signal that the financial media completely ignores. All right, signal number 3, and I saved this one for last because, honestly, this is the one that scares me the most. Because it's not a matter of interpretation, it's pure math, and the math is ugly. Everyone's heard of the yield curve inversion. It's become almost a meme at this point. The yield curve inverted, recession incoming. People have been saying that since 2022. And then the economy kept growing and people started dismissing the yield curve entirely. See, it didn't work this time. The indicator is broken. And that reaction, that dismissal, is the most dangerous thing happening in finance right now, because those people fundamentally misunderstand how this signal works. Here's the thing about the yield curve that almost nobody gets right. The inversion is not the crash signal. I need to say that again because it's so important. The inversion is not the crash signal. The inversion is the warning. The actual signal, the one that has preceded every single recession since 1969, is the UN inversion, the steepening back to normal. Let me use an analogy. Think of the yield curve like a pressure gauge on a boiler. The inversion is when the pressure gauge goes into the red zone. That's dangerous, yes, but the boiler doesn't explode while the pressure is high. The boiler explodes when the pressure suddenly releases, when the gauge snaps back. That rapid normalization is the moment of maximum danger. Why? Because the yield curve typically uninverts. When the Federal Reserve starts cutting rates in response to economic deterioration, they can no longer ignore. The short end of the curve drops as rate cuts take effect. The long end stays relatively stable or rises as the term premium increases, and the curve steepens back to normal. By the time it looks normal on paper, the damage is already in motion. So here's the Q1 2026 picture, and I want you to follow this carefully. The 2-year/10-year Treasury spread inverted in July 2022 and stayed inverted for a historically unprecedented duration, over 2 years. The deepest point was approximately negative 108 basis points in mid-2023. That level of inversion hadn't been seen since Paul Volcker was running the Fed in 1981. Through late 2024 and into 2025, the curve began uninverting, and as of Q1 2026, the 2-year/10-year spread has moved a positive 30 to 50 basis points and is actively steepening. To the untrained eye, this looks like good news. The yield curve is normal again. Crisis averted. No, 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 no. Look at the historical pattern. In 2007, the yield curve uninverted in June. The S&P 500 peaked in October. The recession officially started in December. There was a 6-month lag from yuan inversion to recession, with the stock market peaking roughly in the middle. In 2000, the yuan inversion happened in December 2000. The recession began March 2001. In 1989, the yuan inversion preceded the 1990 recession by approximately 8 months. If the 2024 to 2025 yuan inversion follows the average historical lag, we're looking at a potential recession window opening in late 2026, with the stock market potentially peaking sometime in the months before that. But here's the quirk, the specific obscure thing that almost nobody outside of the bond trading community is watching. It's called the term premium, and its behavior right now is extraordinary. The term premium is the extra compensation investors demand for holding long-term bonds instead of just rolling over short-term ones. Think of it as a fear gauge for the bond market. When investors are comfortable with the economic outlook, the term premium is low, even negative, which it was for most of the 2000s thanks to Fed quantitative easing. In Q1 2026, the term premium on the 10-year Treasury, as measured by the Adrian, Crump, and Moench model from the New York Fed, has surged to approximately 65 to 80 basis points. That is the highest reading in over a decade, and when you combine a rising term premium with a freshly uninverted yield curve and a negative credit impulse, which, by the way, the U.S. credit impulse has turned negative at approximately minus 2% of GDP in early 2026, meaning the flow of new credit into the economy is actually shrinking. You get a trifecta that has preceded severe market downturns with a remarkable degree of consistency. Let me quantify severe. In the 3 previous instances where all 3 conditions were met simultaneously, rising term premium, recently uninverted curve, and negative credit impulse, the S&P 500 declined an average of 38% from peak to trough over the subsequent 12 to 18 months, 38%. On a $300,000 portfolio, that's a $114,000 loss. That's not a number on a screen. That's a house down payment. That's 4 years of college tuition. That's someone's entire retirement timeline getting pushed back by a decade. Okay, so I've just thrown a lot of pretty alarming data at you, and I know what some of you are feeling right now. This pit in your stomach, maybe some panic, maybe the urge to go sell everything first thing Monday morning. Don't. Seriously, do not panic sell. That is the single worst thing you can do with this information. Because here's the psychological trap. The moment you sell everything in fear, you now have to make 2 correct decisions. When to sell and when to buy back in, and almost nobody gets both right. Studies from Dalbar show that the average equity investor underperforms the S&P 500 by approximately 3 to 4 percentage points annually, and the primary reason is poorly timed buying and selling driven by emotion. So instead of panicking, here's what I want you to do. These are 5 specific actionable steps you can take this week. Number 1, run a personal drawdown simulation. Take your current portfolio balance, multiply it by 0.65. That's what a 35% crash looks like. So if you've got $200,000 invested, you're looking at $130,000. Write that number down. Look at it. Ask yourself honestly, say, Not hypothetically, honestly. Can I leave this alone for 3 to 5 years and not touch it? If the answer is no, your allocation is too aggressive for this environment. Number 2, build a tactical cash position of 15 to 20%. I know holding cash feels wasteful when the market's up, but cash is not a dead asset. It's a strategic reserve. Short-term treasury bills, the 3-month and 6-month, are yielding approximately 4.3% to 4.6% in Q1 2026. You're getting paid to be patient, and more importantly, that cash becomes your opportunity fund. The greatest wealth transfers in history happen during crashes, and they transfer from people who have no cash to people who do. Number 3, add a 5 to 10% allocation to gold. Not because gold is going to make you rich, but because gold has a negative correlation to equities during stress events. During the 2008 crash, gold returned approximately positive 5%, while the S&P fell 37%. During the COVID crash, gold held relatively flat in March 2020 and then surged 25% over the following months. It's a shock absorber. A 5% allocation to a gold ETF like GLD or IAU costs you virtually nothing in a bull market but can meaningfully reduce your drawdown in a bear market. Number 4, aggressively eliminate high interest debt. The average credit card APR in Q1 2026 is sitting at roughly 24.5% to 27.8%, depending on the card and your credit profile. That is the highest on record ever. In a recession, if your income drops, banks and U.S. household income declined a median of 7.2% during the 2008 to 2009 recession, that high interest debt becomes a time bomb. Every dollar you throw at a 25% APR credit card balance right now is a guaranteed 25% return. You cannot beat that risk-adjusted return anywhere in the market. Number 5, and please listen to this one. Do not stop contributing to your retirement accounts. If you're putting money into a 401k every paycheck, keep doing it. If the market drops 35%, the shares you buy at the bottom will be worth enormously more during the recovery. This is dollar cost averaging working in your favor. A $500 monthly 401k contribution buying shares at 35% below today's prices is the equivalent of getting a 54% bonus on every dollar invested. Future, you will look back at a 2026 crash as the best thing that ever happened to your retirement, but only if you kept buying. Now, look, I need to address something before we wrap up because I can already feel some of you rationalizing your way out of taking action. Your brain is going to fight you on this. That's not a personality flaw. It's evolutionary biology. Humans have a well-documented cognitive bias called normalcy bias. It's the tendency to assume that because things have been stable, they will remain stable. It's the same bias that caused people in Pompeii to go about their daily lives while Vesuvius was literally rumbling. It's the same bias that led millions of homeowners in 2007 to believe their home values could never decline because home values had never declined in their lifetime. The data doesn't care about your comfort level. The Baltic Dry Index doesn't care that your portfolio looks good right now. The commodity rotation doesn't care that you just bought a new car. The yield curve doesn't care that your financial advisor told you everything is fine. And your financial advisor, look, most of them are good people. I'm not attacking them. But most financial advisors are trained to keep you invested, not to protect you from systemic risk. And their business model depends on your assets staying under management. They're not lying to you. They're just not incentivized to scare you. You have to be your own first line of defense. That's why you're watching this video. That's why that little voice in your head at 11:30 at night keeps whispering. It's not anxiety, it's intelligence. Listen to it. So let me pull all of this together. Signal 1, global shipping rates as measured by the Baltic Dry Index have collapsed over 50% in under a year, while equity markets remain near highs. This divergence has preceded every major market downturn in the last 25 years. Signal 2, the commodity rotation from industrial metals to gold and silver mirrors the exact pattern that occurred in late 2007, with central banks buying gold at the fastest pace in modern history. Smart money is quietly moving to safety. Signal 3. The yield curve has uninverted, which is the actual danger signal, not the inversion itself, while the term premium surges and the credit impulse turns negative. This trifecta has a near perfect track record of preceding severe equity drawdowns. 3 signals, 3 completely independent data sources, 1 consistent message. Could I be wrong? Of course. I could absolutely be wrong. Maybe the market grinds higher for another 18 months and these signals turn out to be noise. But here's the framework I want you to adopt. Prepare so that you benefit whether the crash comes or not. More cash? That's smart regardless. Less high interest debt? Smart regardless. Gold diversification? Smart regardless. Continued retirement contributions? Smart regardless. You don't have to predict the future. You just have to stop pretending that the future is guaranteed to look like the present. If this video made you think differently about your money, even a little bit, hit subscribe. I put out videos like this every week, breaking down the financial signals and strategies that actually matter. Share this with one person you care about, your brother, your mom, your best friend who just put their entire savings into one stock. Someone needs to hear this. Drop a comment below and tell me, which of these 3 signals was new to you? I genuinely want to know, and I read every single comment. Take care of your money. It's the only money you've got. I'll see you in the next one.